For over 2 decades, China has run on a consistent budget deficit. As unbelievable as it sounds, it is true that in one of those years, it was estimated that only 2% of the population actually paid income tax. Why exactly is this, and what effect has it had on the Chinese economy? Find out in this video. Talking about the Chinese economy, China has 2 major problems harming its economic ambitions, especially in the 21st century. They are tax and real estate. What makes this a particularly critical situation is that tax and real estate are the 2 factors considered to be the foundation of a successful economy. China's tax problems are rather serious, and almost all of them stem from the fact that it is the world's 2nd largest economy and is at the same time largely informal. Because of its size, China's economy demands a level of government spending that can be funded only by a large and broad tax base. Unfortunately, that is not the case. Before we make highlights of China's tax problems, let's take a close look at taxation in the rest of the world. The U.S., which is China's closest ally in terms of size of economy, has federal tax revenue of around 17% of GDP, which will add up to 25% of GDP if we include all local and state revenue. On the other hand, the UK's tax revenue has remained unchanged at 32.8% of GDP since 2000. For China, tax revenue is about 9% of GDP, and this has created a large budget deficit for China's tax problems. According to an economic survey, China's tax problem consists of 3 major issues. 1. Tax collection is the responsibility of the local authorities. Next, these local authorities are not given operational power. Finally, local authorities are not allowed to collect taxes from the population because their main source of income is property taxes. The World Bank's economic update has stated that the Chinese central government finds it difficult to collect taxes from most people, seeing that the tax base of the population is currently on a low of 10%. Considering the administrative setup in China, China operates through a central authority, and government authority is shared among provinces that are further divided into sub-provincial regions and cities within those regions. Local governments in most countries are funded by the federal government, but China's local governments are different in that they generate most of their funds by taxing businesses and selling 20 to 70-year leases on their land holdings. It will interest you to know that in China, no private company or citizen can own urban land. Renting it out for 70 years is therefore the next best thing. Now, 60% of the funds these local governments generate from businesses need to be returned to the central government. However, all revenue from land is theirs. Because China's real estate market is a very large one, it has remained a very significant source of revenue. Current surveys show that the confidence of the Chinese in real estate has been destroyed because of the seeming downfall of the sector stemming from high-profile property development bankruptcies evidenced by fewer investments in properties and less being built. It was worse during the COVID-19 pandemic as businesses faced challenges and local government revenue declined as a result of limited business activity. The implications of reduced investments on properties are direct. Invariably, less being built means local governments are generating less revenue from renting out their land holdings. It also means that banks are no longer interested in accepting these land holdings as collateral to underwrite bonds for local government financing platforms. Also, the central government of China started issuing tax returns in a bid to support citizens locked in their homes during the pandemic, while simultaneously pushing for more infrastructure projects to offset the economic impact of the lockdowns. This means less money coming in, more money going out, and fewer options to raise money to bridge the financing gap in the meantime. What impact has China's unique property policy has on the country? While it does seem like a very long time, eventually, 20 to 70-year leases come to an end. Also, shorter leases expire, posing a problem to the government in terms of what to do with the land. Traditionally, it would go back to the government, but this is not a popular solution among home buyers. A survey conducted recently found that the Chinese believe land will never be reclaimed. For example, homes with 20 years left on their leases cost the same as homes with 70 years left on them, all things being equal. Why pay the same price for a home that can be lived in only for 20 years, when you could pay for one that can be lived in for 70 years? They always think. So the people opt for 70 years leases, expecting these leases to take forever to expire. Worse still, poor building standards in China do not allow the houses they build on the land to last long. According to the IMF, China's property crisis intensified in 2022, while calling for further action at the national level by increasing funding for the completion of stalled projects. The IMF noted that accumulating pressures from the unresolved property crisis could trigger a sharp retrenchment in aggregate demand, with adverse macro-financial feedback loops and potentially large external spillovers, insinuating that it could help lead the way to market-based restructuring and contain financial risks. The average net debt-to-equity ratio at the country's top 80 real estate companies rose to 152% by the second quarter of 2022, which is twice what it was in mid-2020, before debt restrictions on property developers were introduced. Surprisingly, despite these huge figures, China keeps insisting its real estate market is not in a crisis. After a report where the IMF said that China's property crisis remains unresolved, China hit back saying its property market has been operating smoothly in general and is not in a crisis situation. Yet, the world knows China's real estate market has been mired in debt woes for the past few years, primarily because property market proceeds are well documented by the IMF. In a report by the IMF, where it released its annual review of China's economy, it said that the real estate crisis remains unresolved and that the country's growth remains under pressure. This is why it is rather shocking that China claims a contrary stand. China's representative to the IMF's executive board, Zhengxin Zhang, and Chuifei Bai, a policy advisor at the IMF, said that the country is aware of the risks and is working to address them, adding that it is inappropriate to overstate the difficulties in the market and potential impacts to the financial sector. Despite China's efforts to reassure investors about the health of its property sector, more than half of 50 mainland China-listed developers are likely to post losses for 2022. And on top of that, investment into China's property fell by 10% in 2022. Irrespective of China's denial, probably solutions to China's real estate issues abound. In this video, we will consider not one or two, but 5 workable solutions. The Chinese government can start by revamping the fiscal system to make local governments less reliant on property development for their revenues. Alternative revenue sources, including a property tax and a bigger share of taxes from the central government, could be a start. In addition, the government could accelerate social housing development using financing sources such as pension funds. Pension funds invest for the long term, and returns on social housing would fit their needs. So the National Social Security Trust Fund is an obvious source of finance. Thirdly, the government could consider isolating households from property development volatility. It could set up an insurance mechanism to protect property buyers against the developers going bankrupt and leaving incomplete housing projects. Also, banks would be encouraged to provide mortgages only to buyers with such insurance. Incentives for banks to carry out proper due diligence can also be reinforced. This would happen if China were to change the legal model for mortgages from the current full recourse model to a non-recourse model, as in the U.S., in which the property is the only collateral the bank can take. Very importantly, the government could speed up the development of alternative investment products for long-term savings. Many households see real estate as their only means for such savings, particularly for pensions. Seeing the modest pensions that the public system provides even for urban workers, such long-term investment vehicles would be in high demand. In conclusion, China's tax problem can be solved by decoupling local government bodies from real estate development, increasing the tax base with stricter enforcement, and investing in high-end manufacturing. All these are options that China has not resorted to so far. Maybe, just maybe, if China begins to admit its woes, it would begin to see solutions and the crisis would be solved. You should subscribe to this channel to see how China's taxation and real estate sector will unfold. Give this video a thumbs up. See you in the comments.